Have you ever heard someone say, "I thought I was ready for retirement until taxes started eating up my income"? It's one of the most painful surprises retirees face. You spend decades saving and planning, only to realize Uncle Sam wants a slice of your hard-earned money even after you stop working. But here's the truth. You can enjoy a comfortable, tax-efficient retirement if you understand where the traps are and how to legally avoid them. So in today's episode of Golden Years Finance, we're going to unpack the 7 biggest retirement tax traps and, more importantly, how you can sidestep them to keep more of your income, reduce your stress, and live out your golden years with peace of mind. Welcome back to Golden Years Finance, where we help smart, everyday people make wiser money moves for life after 50. I'm your host, and today we're tackling one of the most overlooked parts of retirement planning, taxes. Because here's what most people don't realize. Taxes don't retire when you do. They keep coming sometimes from directions you never expected. But if you know the system and plan ahead, you can turn your tax bill into a retirement advantage. So grab a notebook, you'll want to take notes on this one. 1. Social Security taxation confusion. Let's start with one of the biggest shocks for retirees. Many people believe that once they start collecting Social Security, those benefits are tax-free. Unfortunately, that's not always true. Depending on your combined income, which includes your adjusted gross income, plus non-taxable interest, plus half of your Social Security, you could end up paying taxes on up to 85% of your benefits. Here's the breakdown. If you're single and your combined income is above $25,000, you'll start owing taxes. If you're married and filing jointly, that threshold is $32,000. These numbers haven't changed since the 1980s, even though inflation and incomes have soared. Avoiding the trap. One of the smartest moves is ***, controlling your taxable income *** before you claim Social Security. Consider drawing from Roth IRAs or tax-free accounts. First, these don't count toward your combined income. You can also use a Social Security timing strategy, delaying your benefits until your taxable income drops or your spouse retires. 2. Required minimum distributions, RMDs. Here's another sneaky one. You've been diligent about saving into your 401k or IRA for decades, but when you hit a certain age, the IRS says, now it's time to start taking that money out and paying taxes on it. That's called a required minimum distribution, RMD. As of 2025, you generally have to start IMDs at age 73, or 75 if you were born after 1960. The problem? Those distributions can * bump you into a higher tax bracket, increase your Medicare premiums, and even make more of your Social Security taxable. Avoiding the trap. Start Roth conversions in your 50s or early 60s, gradually moving money from traditional IRAs into Roth IRAs, so future withdrawals are tax-free. If you're still working and don't need the income, delay RMD from your current employer's 401k. And always work with a tax professional to map out your RMD forecast before the IRS does it for you. 3. State taxes a hidden bite. Many retirees are shocked when they realize their state tax is retirement income too. Not all states treat retirement income equally. Some, like Florida and Texas, have no state income tax. Others, like California, Minnesota, and Connecticut, can be brutal. Even if you think you've escaped, things like property taxes and sales taxes can quietly erode your retirement lifestyle. Avoiding the trap. Research the tax climate where you plan to retire. Don't just look at income taxes, compare property, sales, and inheritance taxes. Consider partial relocation, for example, spending part of the year in a low-tax state and the rest near family. Use tax diversification. Spread your income across taxable, tax-deferred, and tax-free sources to stay flexible. 4. Capital gains on downsizing. A common retirement move is to sell your home and downsize. That can be a smart lifestyle and financial decision, but it can also come with a hidden tax hit. If your home has appreciated significantly, you might face capital gains tax on the sale. You can exclude up to $250,000 of gain as a single filer, or $500,000 if married filing jointly, but only if you've lived in the home for at least 2 of the last 5 years. Avoiding the trap. Plan your sale timing carefully. If you're close to retirement, consider waiting until your taxable income drops. This could qualify you for a lower capital gains rate. Or, If you plan to move anyway, explore 1031 exchange options for investment properties to defer taxes. 5. Forgetting about Medicare surcharges. Most people don't connect their taxable income to their Medicaid premiums, but they are directly linked. If your modified adjusted gross income, MAGI, goes above certain thresholds, you will pay an income-related monthly adjustment amount, IRMA, basically a surcharge added to your Medicaid Part B and D premiums. In 2025, that can mean paying hundreds or even thousands more each year. Avoiding the trap. Keep an eye on your income 2 years before you enroll. That's what Medicare uses to calculate your premium. Use Roth accounts strategically to keep taxable income lower. And before selling large assets or doing Roth conversions, run the numbers to see if it'll push you into IRMA territory. 6. Ignoring inflation and tax bracket creep. Even modest inflation can push your income into higher brackets over time, a silent form of taxation called bracket creep. If your income rises with cost of living adjustments, but tax thresholds don't keep pace, you could end up paying a higher percentage in taxes each year even if your real income hasn't grown. Avoiding the trap. Use tax diversification to manage income levels annually. Consider indexing your withdrawals, taking slightly more from tax-free sources as inflation rises. And stay alert for annual tax law updates that adjust brackets and deductions. 7. Not having a withdrawal strategy. Here's one that ties it all together. Even if you've done everything right, saved diligently, diversified your investments, you can still lose thousands if you withdraw in the wrong order. For example, pulling from tax-deferred accounts too early could spike your taxes. On the flip side, draining your Roth too soon could reduce your future flexibility. Avoiding the trap. Think of retirement withdrawals like a puzzle. Start with taxable accounts, brokerage, savings, then move to tax-deferred, 401k or IRA, and save tax-free, Roth, for last unless you're strategically managing your tax bracket. Better yet, create a written retirement income plan that includes taxes so you know where every dollar will come from and how it'll be taxed. Story segment. Let me tell you a story of a couple, David and Linda. They both retired at 65. David had about $500,000 in his 401k, while Linda had a modest pension and Social Security. They thought they were all set until tax season hit. Between RMDs, Social Security taxation, and selling their vacation home, they owed nearly $12,000 more in taxes than they expected. They weren't extravagant spenders, they just didn't realize how their income sources interacted. A financial planner helped them reorganize their withdrawals, delay one of their Social Security benefits, and do partial Roth conversions. Within 2 years, they reduced their annual tax bill by over 30%, and that saved money stretched their retirement fund years longer. That's the power of awareness and strategy. Final thoughts. Retirement is supposed to be about freedom, not frustration over tax bills. Yes, taxes can be complicated, but they are also predictable if you take the time to understand them. The truth is, every dollar you save in taxes is a dollar that stays in your pocket working for you instead of against you. So, don't just plan for your retirement income. Plan for your retirement tax efficiency. If you found this video helpful, do 2 things. Subscribe to Golden Years Finance. We post weekly videos to help you protect your money, maximize your benefits, and live stress-free in retirement. Remember, you worked hard for your money. Don't let taxes take more than their fair share. Thanks for watching, and I'll see you in the next episode of Golden Years Finance, where we help you live smarter, richer, and more secure in your golden years.